So if you're a dividend investor and you like dividend stocks, you like cash flow, buying dividend ETFs, investing your portfolio in dividend stocks, at some point along the way, you've probably heard of or checked out both Globalx's DIV and SDIV. Both of these dividend ETFs have high dividend yields and they pay monthly, and the very names of the dividend ETFs, SuperDividend, makes it seem like a great investment for the average Joe dividend investor. But the real big questions we have here are, number one, do we have all the information we need about DIV and SDIV to make an informed decision? And maybe the most important question, number two, is, are these investments a good fit for our portfolio? What's up, you guys? Welcome back to the Average Joe Investor channel. My name is Joe, and in this video we are talking about two investments from Globalx, two dividend ETFs, the Globalx SuperDividend US ETF, DIV, and the Globalx SuperDividend ETF, SDIV. In this video, I'm gonna break down for you exactly what each of these dividend ETFs are all about, what their important information is, their expense ratio, how long they've been in existence, and then secondly, we're gonna take all the information we have about these funds and we're going to plug it into one of my spreadsheets that I've created. We're gonna look at it from three different investing strategies: monthly without reinvesting, monthly with reinvesting dividends, and a lump sum investing strategy. And make sure to stick around all the way to the end because I've got a great surprise for you after we've taken in all the information we need to about both of these ETFs. You guys know how much I love to talk about dividend stocks, dividend ETFs, cash flow, and index funds, and everything in between. So if you appreciate this video, if you've learned something new, if you find any value out of it, hit that like button, hit the subscribe button, and let's get started. Hey guys, Joe here. If you're new to the channel, make sure to hit that subscribe button below the video to make sure you don't miss any of my future videos. And if you do click that subscribe button, make sure to leave me a comment below saying you subscribed, and I promise to personally respond to your comment. All right, you guys know how I never want to waste your time, so without further delay, let's go ahead and jump right into the content here. The first thing we're going to talk about is what exactly are these two dividend ETFs. First off, let's talk about the Globalx SuperDividend US ETF, DIV. As it says right here on the fund summary, the Globalx SuperDividend US ETF invests in 50 of the highest dividend yielding equity securities in the United States. It says here, why DIV? Well, first off, high income potential, monthly distributions, and interestingly enough here, low volatility. DIV's index methodology screens for equities that have exhibited low betas. In other words, when we say low beta, we're talking about how the price changes both high and low compared to other investments, mainly the S&P 500, in an effort to produce low volatility returns. As you can see right here, we've got a total expense ratio of 0.45%, and then we've also got a distribution yield currently of 4.95%, which is paid out on a monthly basis. If we scroll down further here, we can see the actual sector breakdown. We've got primarily consumer staples at 25%, real estate at 17%, industrials at 11.7%, energy at 11.4%, and utilities at 9.7%. We look at the top holdings here. Some of them you're familiar with, some of them you might not be. Holly Energy Partners, Iron Mountain, CubeSmart, those number 2 and number 3 are real estate investment trusts. And we've also got further down here investments we've talked about on this channel and that I've owned previously in my portfolio, such as 3M. And then also Westlake Chemical, which is actually currently in my portfolio. The inception date for this DIV fund is March 11th, 2013. Next up here, we've got the Globalx SuperDividend ETF, SDIV. It says right here that it invests in 100 of the highest dividend yielding equity securities in the world. So why SDIV here? It says, well, high income potential, okay, monthly distributions, yes, and then global exposure, to invest in equities from around the globe, which can help diversify both geographically and with interest rate exposure. It says right here the total expense ratio, 0.59% right here, and it's got a distribution yield on a monthly basis of 6.47%. It's actually annually 6.47 divided by 12. Now if we scroll down here, we've got a sector and a country breakdown for SDIV. On the sector breakdown, we've got 43.8% real estate, interestingly, and then financials 11.3%, energy 10.8%, and then industrial 7.9%, everything else less than 6%. Then we've got a country breakdown here. United States makes up about 30% of the net assets, China at 17%, Hong Kong at 11.4%, Britain at 6.4%, and then everything else, Brazil, Australia, Thailand, etc., are below 5%. And what's interesting here, if we scroll down to the top holdings, a lot of these you may have never heard of because they are, well, foreign holdings for the most part. You have to scroll down pretty far to get some holdings that we are familiar with, such as Iron Mountain down here, and other investments such as, let me scroll down here, a lot of them never heard of, right? Arbor Realty Trust is a real estate investment trust here in the United States as well. All right, guys, let's go ahead and dive into my spreadsheet here and start taking a look at some of the data. All right, so here is the Excel spreadsheet, guys, and just as an FYI, I mentioned this in all of my videos, but every time I make a video, most often I make a spreadsheet to go along with it, and I make all these spreadsheets available to my Patreon community. So you can get access to these, you can get access to my specific investing strategies with my dividend portfolio, as well as the specific changes I make and the actual dividend stocks that I'm buying. If that interests you at all, if you find some value from that, then check out the link in the description below. Okay, so we're looking here, we've got 3 different investing strategies. If we scroll over here, we've got monthly contributions, not reinvesting dividends. Then we have monthly contributions with reinvested dividends, and we finally have a lump sum, not reinvesting any dividends. And as you see up top here, we've got the entries we can change here. We've got the monthly contribution we can adjust, the annual cost of living adjustment on the monthly contributions, and the lump sum investment here. Now, just so you know, the monthly contribution is not there to identify what the average Joe is supposed to contribute on a monthly basis. We're all in different positions. Some of us have the ability to invest thousands of dollars a month. That's not me necessarily month to month. And then others of us are struggling just to put in $50 to $100 a month. Point is not to compare ourselves to what I'm putting in this spreadsheet, but just to know that we have these adjustments here we can make, and I sometimes will inflate that number to magnify the differences to show you how different investments perform. So we've got the monthly contribution, we'll start at 100, we'll show you a few different looks there. The annual cost of living adjustment here, we've got 2%, and then the lump sum investment of $250,000. So first off here, like we said, we've got the GLOBAL X SuperDividend US ETF, DIV, then SDIV, we've got their expense ratios, their holdings, the date they were created. That's not correct here because SDIV was created in 2011. Whoops. And then the price, annual dividend, and dividend yield. So then here for each of these different strategies, we've got trailing 12 months of dividends and portfolio value for each of these 3. Trailing 12 months means that at the end of the period from January of 2014 through June of 2021, 7.5 years, the last 12 months of investments, how much dividends were produced. Trailing 12 months of dividends. And then we've got portfolio value here. First thing we're gonna look at here is gonna be the monthly contributions while not reinvesting any dividends here. And just for your awareness, I did include here the amount of contributions. This is just taking into account what the monthly contributions are and the cost of living adjustment. Over the entire period, contributions would be $9,733.89. All right, so let's go ahead and start here. We'll look at the trailing 12 months of dividends and portfolio value. Let me go ahead and open that up here. Okay, so at the end of the period of 7.5 years, we would have portfolio values here, and this should catch your eye, of $84.79 and 75 cents with DIV, and we would have for SDIV $7,617.71. That should be alarming to you guys because that is less than the amount of money we contributed. We've got here trailing 12 months of dividends of $445.12, which is great to get that much from this portfolio. Same with $465.86 from the SuperDividend International SDIV here. But the truth of the matter is we have $1,300 less here for DIV and almost $2,000 less here for SDIV than what we started with the actual amount of contributions. If nothing else warns you about this video, this should definitely warn you guys. You know, with QYLD in a previous video, we talked about how there was a small amount of capital depreciation, but this is a lot more significant here. We're talking like almost 25% less in value in just 7.5 years. Let's pop over here to monthly contributions with reinvested dividends here. Let me scroll even further so you guys can see it right in the middle of the screen. Let's open this up and see what it looks like. So in this case, we're reinvesting dividends, and in this situation with DIV, we actually do have a portfolio value exceeding what we contributed. We contributed $97.33.89. We now have $10,468.16, and trailing 12 months of dividends, $545.17. For SDIV, we've got $95.24, which is still less than what we contributed, even though we were reinvesting dividends. That has got to be a massive warning sign. And we have $577 in trailing 12 months of dividends. And what I want to show you guys is here is for both of these investments, if I scroll over here, we can go ahead and change the monthly contribution. Let's say we, instead of $100 a month, let's change it to $500 a month. In this situation, guys, in 7.5 years, not reinvesting dividends, we would have contributed $48,669. We'd only have $42,000 with DIV and only $38,000 with SDIV. That is a loss of $10,000. If we reinvest the dividends, scrolling over here, same amount of contributions, 48,669, we would have 47,000 with SDIV and we'd have 52,000 with DIV. Even with reinvesting dividends, guys, that is a big warning sign. Let's take a look at the lump sum investment here. Let's start with $250,000 and let's see what the trailing 12 months of dividends and the portfolio value would be here. Come over here and open that up. So starting with, we start with $250,000 in January of 2014, and at the end of June 2021, we have a lot less money in our portfolio. $188,000 with DIV and $155,000 with SDIV. Yes, we've got great trailing 12 months of dividends, right? 10,978 or 10,602 with a relatively small portfolio, but at the same time, guys, that is a lot of money lost. That is that's over $95,000 less with SDIV and about maybe $60,000 less with DIV. So you can see here, both of these funds, they don't have really great results. But the reason why I wanted to share and have you guys stick around all the way to this point here, so thank you for being here, is that, you know, the whole reason we would own DIV is to have significant dividend yield, right? We wouldn't own it for exposure necessarily because it's only got 50 different ETFs, 50 different dividend stocks in the portfolio. You own it to increase your dividend yield. And we can see that with this fund, we are losing capital value over time over the duration of this fund. And then with SDIV, you might own it for dividend yield, yes, but also for exposure. And make sure you should stick around for the next video because the next one's gonna be all about dividend ETFs, international dividend ETFs, so stick around for that. But you would own these primarily because of the significant yield, but we have significant capital loss. So what's a great alternative? Well, I'll tell you what's a great alternative. Thank you for sticking around all the way to the end here. Let me go ahead and reveal field number 7, which is one that, you know, you're gonna be like, oh, of course I saw that coming after I show it to you. Of course I would be talking about QYLD, the NASDAQ 100 Covered Call ETF. We have 100 holdings. And we've talked about QYLD in previous videos, so I'm not gonna go over how the fund works, but it's a significantly high dividend yield. We have a lot less capital reduction in our value. So if we look here, let me just reveal all of these for you at one time here. Same investing strategies, same time period. All the results are here, guys. Let me just unhide this one result as well. All the data is here. We got QYLD as well. All the data. With these funds, if I reveal all the data here, you can see that instead of $445, this is based on monthly contributions of $100 a month here. Instead of $465 and $445 trailing 12 months of dividends after 7 years, we'd have $1,000. We'd have capital value of $94.83, which is more than we invested. 9,000 versus 94.83, not reinvesting dividends, so just the overall capital value would be higher. I apologize, guys. I just realized that the amounts I was putting down here for capital value was not it was the monthly contribution, but didn't account for cost of living adjustment. So this might actually be a little bit lower than what we actually contributed here. Actually, what I can just sum this up here. There we go. So 97.33 here, 89 versus. So we would still have a little bit of reduction in value with QYLD when we're not reinvesting dividends here with a monthly contribution, but very little compared to the other two. If we look at the lump sum investment here, instead of having $2,100 in trailing 12 months of dividends after 7 years, we'd have $5,262, which is significantly higher. And then if we look at the lump sum value here, yes, we have a reduction in value, but nowhere near with the other two. If we started with $50,000, we'd have $44,627. If we started with, we'll say, $250,000 again, we'd have $223 versus $155 and $188. And let me just scroll over here. And then if we look at monthly contributions with reinvested dividends, we'd have at the end of after 7.5 years, trailing 12 months of dividends would be $1,371 versus $577 and $545. And the portfolio value would be higher too, $12,957 versus $95 and $10.4. So if we're picking up SDIV and DIV for diversification, you get the same diversification with QYLD. If you're, well, not quite if we're talking about international, but we'll get there in a future video. But with respect to DIV, you get the same exposure. And similar in that the number of holdings is actually higher with QYLD versus with DIV. If we're talking about we own it because it's got a high yield, we get a higher yield with QYLD and less portfolio value reduction. Very little with QYLD. We don't know what the future holds, but just on what's actually happened with the actual dividend results and the actual price history since 2014 through 2021. Guys, let me just show you a few graphs here. Again, all this data is going to be available in the Patreon community. All the contributions. You can see this is just the price history It just shows you the price history along the way here. You can see there's significant drops with SDIV and DIV with the COVID-19 correction, whereas it was very muted with QYLD and it recovered relatively quickly, whereas it took a long time. SDIV still hasn't recovered from its high from pre-COVID, and neither has DIV either. If we look here at monthly contributions based on reinvesting dividends, we can see here that QYLD is just blowing away the competition here with DIV and SDIV. We've got our monthly contributions not reinvesting dividends. You can see the difference here between QYLD and SDIV and DIV down here. Lump sum investment with not reinvesting dividends. We can see we're actually a little bit lower with QYLD right here, but then they're about the same coming along here. And then at the COVID correction, things just fell off a cliff for DIV and SDIV, whereas QYLD stayed pretty consistent. Scroll down even further, we've got cumulative dividends with monthly contributions. So if we were assuming monthly contributions, we've got QYLD reinvesting dividends and not reinvesting dividends blowing away the competition here. You can see the differences here when we look at the cumulative dividends with monthly contributions, reinvesting dividends versus not, that QYLD, both reinvesting and not reinvesting, just completely blow away the competition here. And then scrolling down here, when we look at lump sum investment cumulative dividends, we can see here that QYLD, with respect to the lump sum investment, has generated over $160,000 in dividends. This is based on $250,000 investment, and then SDIV and DIV are just much lower than QYLD. So at the end of the day, I want you to take away from the fact that both DIV and SDIV, they really pride themselves on being high dividend ETFs, but the truth of the matter is, we can achieve better dividend yield if we really want to, and we don't have to based on our investing strategy. But secondly, the amount of capital we are losing with DIV and SDIV in our overall portfolio value is significant. If we want to avoid that, we need to pick other dividend ETFs, or we can pick up QYLD or stick with dividend stocks here. Hopefully you found some value from this video, guys. Make sure to leave your 2 cents down in the comments below. What did you like about it? What did you want to see that I didn't present to you in this video? What are some other video topics you want to see more about? Next video, guys, is going to be a big one. It took a ton of time. I took out, I think the top 20 or 21 international dividend ETFs, not US, just Global X US, and we took a look to see which one performed the best in the same 3 types of strategies here: monthly contributions without reinvesting dividends, monthly contributions with reinvesting dividends, and a lump sum investing strategy. It took a long time, so hopefully you find a ton of value out of that video, which is coming up next. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.